Mutual funds are investment vehicles. They pool money from many investors. This pool is used to buy a basket of assets. These assets can be stocks, bonds, or other securities. Mutual funds offer diversification. Index funds made diversification easier. They are professionally managed. By spreading investments, mutual funds aim to reduce risk. Mutual funds have become very popular. They are now a cornerstone of many investment portfolios. Mutual funds are designed for diversification. But why invest in multiple funds? Wouldn't one diversified fund be enough? While one fund offers diversification, multiple funds can provide more targeted exposure. Investors have different goals. Some aim for growth, others seek income. Multiple funds allow investors to tailor their portfolios. They can choose funds that align with their specific objectives. For example, a young investor might choose a growth-oriented fund. An older investor might prefer a balanced fund. Multiple funds provide this flexibility. They allow you to create a portfolio that matches your risk tolerance and investment goals. Moreover, different funds may perform differently in various market conditions. Holding multiple funds can help manage risk. It can also potentially enhance returns over the long term. Diversification is important, but over-diversification can be harmful. Holding too many funds can dilute potential returns. It can also make it harder to track your investments. Overlapping holdings is a common problem. When multiple funds hold similar assets, it reduces diversification benefits. It can also increase expenses if you're paying fees for overlapping holdings. Imagine owning 3 different large-cap stock funds. These funds likely hold many of the same companies. This overlap reduces diversification and increases costs. It's essential to choose funds strategically, ensuring they complement each other. Furthermore, managing numerous funds can become complex. Each fund has its own paperwork and reporting requirements. This can be overwhelming, especially for investors with limited time. While over-diversification is a risk, multiple funds can be beneficial. They offer targeted exposure and enhance portfolio customization. Investors seeking specific sector exposure might find multiple funds useful. This provides concentrated exposure to that sector. Multiple funds help manage risk across different asset classes. This diversification can cushion the portfolio during market volatility. Dollar-cost averaging can reduce the impact of market fluctuations. Section 5. Diversifying without overdoing it. Diversification is key, but avoid over-diversification. Choose funds that complement each other, providing broad market exposure. Start with a core holding, like a target date fund. Then add funds that fill specific gaps. Consider your risk tolerance. If you're risk-averse, stick with broadly diversified funds. If you're comfortable with more risk, you can add specialized funds. The key is to strike a balance that aligns with your investment goals. Review your portfolio regularly. Ensure the funds still align with your objectives. As your financial situation changes, so should your portfolio. Reassess your asset allocation periodically to maintain proper diversification. Remember, diversification is about managing risk, not eliminating it entirely. There will always be market fluctuations. A well-diversified portfolio helps you weather those storms. Section 6. Matching investments with time horizons. Your time horizon is crucial when choosing mutual funds. If you have a long time horizon, you can take on more risk. Younger investors, for example, might choose growth-oriented funds. Growth funds invest in companies with high growth potential. They may be more volatile in the short term, but over the long term, they have the potential for higher returns. This makes them suitable for investors with a longer time frame. As you get closer to retirement, shift towards a more conservative approach. Consider funds with a mix of stocks and bonds. This balance can help protect your savings as you approach retirement. Target date funds are a popular option for retirement savers. They automatically adjust their asset allocation as you age. This takes the guesswork out of managing your portfolio as you approach your retirement date. Section 7. Seeking value-added investments. When choosing mutual funds, look for value-added investments. These are funds that offer something unique. They could provide exposure to specific sectors, themes, or investment styles. For instance, consider a fund that invests in renewable energy. This fund aligns with a specific investment theme. It allows investors to participate in a growing sector while potentially benefiting from long-term trends. International funds provide diversification beyond domestic markets. They invest in companies based in foreign countries. This exposure can enhance returns and reduce overall portfolio risk. Different markets often perform differently, providing a hedge. Actively managed funds are another option. These funds have portfolio managers who actively buy and sell securities. They aim to outperform a specific benchmark or index. However, actively managed funds typically have higher fees. Section 8. The importance of active monitoring. Once you've invested in mutual funds, active monitoring is crucial. Regularly review your portfolio's performance. Ensure the funds are still meeting your expectations and aligning with your goals. Keep an eye on market conditions. Economic events can impact fund performance. Stay informed about factors that might affect your investments. This allows you to make informed decisions about your portfolio. Pay attention to fund expenses. High fees can eat into your returns over time. Compare expense ratios among similar funds. Choose funds with reasonable fees to maximize your investment growth. Don't hesitate to make changes if needed. If a fund consistently underperforms or no longer aligns with your goals, consider selling it. Reinvest the proceeds in a more suitable option. Section 9. Rebalancing. Keeping your portfolio on track. Rebalancing is the process of adjusting your asset allocation. Over time, your portfolio's mix of stocks, bonds, and other assets can drift. This can happen due to market fluctuations or changes in your investment goals. Rebalancing involves selling assets that have performed well and buying assets that have lagged. This helps maintain your desired risk level and keeps your portfolio aligned with your long-term objectives. How often you rebalance depends on your risk tolerance and investment strategy. Some investors rebalance annually, while others do it less frequently. The key is to have a plan and stick to it. Rebalancing can be an emotional process. It's tempting to hold on to winners and sell losers. However, rebalancing forces you to buy low and sell high, which is a disciplined approach to investing. Section 10. Conclusion. Mastering your mutual fund portfolio. Mastering mutual funds involves understanding their benefits and risks. Diversification is essential, but over-diversification can be detrimental. Choose funds that complement each other and align with your investment goals. Match your investments with your time horizon. Younger investors can take on more risk, while those nearing retirement should prioritize capital preservation. Seek value-added investments that offer unique exposure or align with your investment philosophy. Actively monitor your portfolio's performance. Rebalance periodically to maintain your desired asset allocation. By staying informed, making adjustments as needed, and seeking professional guidance when necessary, you can build a mutual fund portfolio that supports your long-term financial well-being.